The MOTR risk gauge is basically our lie detector or our truth serum. And it's what we use to determine whether or not the market's telling the truth or not. What's in the risk gauge are concepts that I call inviolable. They're first principle types of inputs. There's only five of them, and they're all technical, by the way. They're not fundamental. They're not interest rates, what the Fed is doing, what valuation is, or anything like that, because those things don't have to be relevant in the moment. Things that are in this risk gauge are things that must be true. To give you a really simple, but painfully simple, but perhaps why it's so powerful, you will never in your life ever see a bull market that looks like this. You will never see a bear market that looks like this. That's inviolable, right? It's a first principle to trend following. Concepts like that are inviolable. Those kinds of concepts are what make up the risk gauge. So they're inviolable and they're based on first principles. So what we have is when we aggregate those five principles across three time frames, we have a long-term time frame, which is the quarterly chart. This is the monthly chart, and then this is the weekly chart. What we're trying to identify is, are we in a risk-on environment, a mixed environment, or a risk-off environment? And this is critically important because what it tells you is what you should do with the next oversold condition, or during periods of market weakness, should you be buying it or not? Or even during periods of market weakness, should you be selling it? Or during periods of market strength, should you be buying it? Like if its stock is breaking out or the market is breaking out, should you be selling it? Should you be shorting it? Those are the distinctions that this risk gauge is trying to help us identify. And when we're in risk on, we want to focus on trend following, which means just basically buy and hold the trend as long as you can, stay fully invested, no short exposure in a bull market when you're in risk on. You want to be buying weakness and you want to be ignoring overbought. Overbought's good in a bull market. It's the reason you got long to begin with. You know, the more overbought, the better. So the risk gauge will look something like this. When it's in mixed, the risk gauge will look something more like this. And this is not bullish. It's not bearish. What does that mean? Well, it means exactly what it says. It's mixed. And in this scenario, you want to be very tactical. You want to reduce your risk overall because there's no reason to be max risk in a non-trending environment. But you also want to be flexible in your execution of your strategy. So if you're a long-term investor allocator and you're in a mixed environment, you don't want to be chasing the market higher and adding when it's overbought. The market's in a range-bound environment and you're going to be buying the high. You want to wait for the market to get oversold. If you're more tactical, then you want to be buying when the market's oversold or after periods of market weakness and selling after periods of market strength. And if you're an aggressive tactical investor, you can get short. So regardless of who you are, you can translate where the risk gauge is into your action plan for the day. And if it's mixed, just remember that both oversold matter and overbought matter. And then, of course, the one we all fear and not a fun place to be is this risk off. And this is what the gauge looks like when it's in risk off. In this scenario, you should have high cash balances, super tactical. You can have short exposure on it if you're so inclined and if that's part of your mandate. But here you want to sell overbought and you want to ignore oversold. So like in risk on, you want to ignore overbought. When you're risk off, you want to ignore oversold because you're in a bear market. In oversold conditions in a bear market likely will be followed by lower lows. So you want to be patient, retain your cash balances and wait for the risk gauge to inflect. Basically encompasses all of the tools that I've been following for 35 years. It's just a really robust way to aggregate these very complex concepts across three timeframes into one indicator to help us make less biased, less emotional decisions. Just by way of example, we have this all the way back to 1950, but I'm just going to very quickly walk you through how this can help you navigate even a very turbulent moment like the global financial crisis. So the first quarter of 2007, we were still in risk on. We were in risk on for a while. So risk on means what? I just described it. It means buy weakness, buy breakouts, ignore overbought. So this is where we were in the first quarter of 2007. At the end of the second quarter of 2007, we can see that we've dropped into mixed. So we're really focusing on this medium-term time frame. This is the monthly chart. So this is a very long-term chart. And so with this indicator dropping to mixed, despite the fact that along the way, the market went out to new highs, and yet the risk gauge still dropped to mixed, is your warning that the market's lying. It's not nearly as healthy as it's trying to tell you that it is. Fast forwarding to the next quarter, and we have a significant drop in the monthly time frame. Now, what does that mean? Well, it's still mixed because this is still up here in risk on. So therefore, it still means buy weakness and sell strength. If you were a long-term investor, this is a terrible place to add. Let's say you just got a $1 million allocation from a client and you're asking, should I put the money in now? This is a terrible place to do that. You should wait for it to get oversold. That's the way you would use this. If you're more tactical, perfect place to sell whatever you bought for a trade or even get short if you're that aggressive. Moving to the next quarter, we ended up with the long-term, again, this is the quarterly chart, falling completely out of risk on. And we now have the monthly gauge in the bottom half of mixed. This is where you can actually really entertain the idea of the next overbought condition you should be shorting. Or the next overbought condition, if you're a long-term allocator, you should be raising cash. Definitely not, allocating that incremental $1 million that you got from your clients in terms of new assets. So when we fast forward to the next quarter, we're now in risk off with the monthly time frame in risk off. Next overbought condition is where you want to take very defensive maneuvers, whether it's raising cash, resisting allocating that new $1 million, or getting short if you're aggressive. And of course, as you can imagine, if it was already bearish by then, the risk gauge stayed bearish all the way through the GFC. And then at the bottom, there's no effort here to call the bottom in any of the work that I do, but which it did not do. But at the bottom right here, it did go to mixed. So now you're taking on more risk. You're trying to buy weakness, buy oversold conditions, perhaps selling overbought conditions. And then as you go into the next quarter, we're back in risk on, and where, as you can read here, it's buy weakness, buy breakouts, no short exposure, fully invested, etc. If you found it helpful seeing how the risk gauge navigated the 2008 global financial crisis, check out the link in the description to subscribe to our free monthly risk gauge update. And if you want more frequent updates, including gauges on all 11 US sectors, join the weekly risk gauge update, also linked below. Thanks for watching.